In the late 1980s, the Indian stock market was expanding rapidly, yet it operated almost entirely on physical stock certificates and weakly regulated honor systems. The government established the Securities and Exchange Board of India in 1988 to monitor this growth. However, it was created as a non-statutory body. It could observe the market, but it had no legally enforceable power to intervene. The consequences materialized in the 1992 Harshad Mehta Securities Scam. Brokers exploited massive systemic loopholes to manipulate stock prices and siphon funds. The immediate legislative response was swift. The government passed the SEBI Act on January 30, 1992. This legislation conferred full statutory powers, transforming SEBI from a passive observer into an independent regulator armed with the legal authority to enforce compliance. This transition established that a rapidly maturing market requires a referee with the statutory weight to intervene directly when systemic linkages fail. Designing a financial regulator presents an engineering problem. How do you grant an institution the agility to develop a market, the rules to structure it, and the teeth to punish bad actors? India's solution is a specific structural model, a 3x3 matrix of functions and powers. The blueprint for this matrix is the statutory preamble to the SEBI Act of 1992, which mandates the state to protect the interests of investors in securities and to promote the development of and to regulate the securities market. That single sentence establishes three distinct objectives: investor protection, market regulation, and market development. These three objectives form the vertical columns of SEBI's operational matrix, which are activated by three specific statutory powers. This grid provides the framework for analyzing how SEBI executes its mandate across every sector of the Indian financial landscape. The first column of the matrix is the protective function. This mandate directly targets market abuse and fraud to shield investors. Concrete outputs of this function include the prohibition of insider trading regulations, which restrict trading on unpublished price-sensitive information, and SCORES, SEBI's centralized online grievance redressal system. The second column is the regulatory function, which encompasses the licensing and daily oversight of market infrastructure. This grants SEBI authority over stock exchanges, clearing corporations, brokers, and mutual funds. SEBI operates within a specific jurisdictional boundary. In India's four-pillar financial system, SEBI governs securities, but it does not regulate the banking sector. That remains the domain of the Reserve Bank of India. For corporate actors, SEBI exercises its regulatory authority through two primary frameworks: LODR, which dictates ongoing compliance and disclosures for listed companies, and SAST, the takeover code governing major acquisitions. These specific frameworks were tightened to enforce stricter corporate governance following systemic shocks like the Satyam and ILFS defaults. The protective function acts as a shield for the vulnerable, while the regulatory function builds the operational fence around the entire market. The final column is the developmental function. Here, SEBI is tasked with expanding the breadth, liquidity, and sophistication of the Indian market. A historical application of this mandate was the transition to electronic, dematerialized shares via the Depositories Act of 1996, eliminating the physical paper bottlenecks of the past. Today, SEBI uses this function to incubate and oversee new financial products, such as real estate and infrastructure investment trusts. It also mandates continuous training to professionalize market intermediaries and actively promotes the formation of self-regulatory organizations. Through this developmental mandate, SEBI builds the technical and regulatory infrastructure required for capital formation in the broader economy. To enforce those three vertical functions, SEBI wields three distinct legal powers along the horizontal axis. First is quasi-legislative power. SEBI holds the authority to draft and issue binding rules and guidelines, such as the ICDR regulations that govern primary market IPOs. Second is quasi-executive power. This provides the enforcement toolkit required to ensure compliance, conduct inspections, and launch active investigations. Practically, this means SEBI can execute search and seizure operations on suspected manipulators or issue immediate ex parte cease and desist orders to halt fraud while an investigation is pending. Third is quasi-judicial power. SEBI can conduct hearings, pass orders, and adjudicate violations. A prime example is disgorgement, forcing wrongdoers to surrender ill-gotten gains. SEBI can also levy massive monetary fines or issue permanent bans, restricting individuals from accessing the capital markets. This structure allows SEBI to draft rules, investigate suspected breaches, and pass judicial-style orders, all within the same institution. This consolidation of power raises a critical question. How does India prevent a regulator with legislative, executive, and judicial authority from overreaching? The systemic safeguard is the Securities Appellate Tribunal, or SAT. SAT is an independent, specialized body. Any entity aggrieved by SEBI's quasi-judicial orders can appeal their case here, ensuring external judicial review over the regulator's decisions. Furthermore, if a dispute involves a substantial question of law, appeals can bypass SAT and escalate directly to the Supreme Court of India. SAT acts as the essential pressure valve. It gives SEBI's orders real enforcement weight while preserving necessary checks and balances. We can test the utility of this 3x3 matrix by mapping it directly onto the market microstructure overhauls implemented in the 2025 to 2026 timeframe. This diagram illustrates the 2026 rollout of the optional T+0 settlement cycle. Sellers receive 100% of funds and buyers their securities on the exact same trading day. Mapping this, building same-day infrastructure is a developmental function, executed using quasi-legislative power. This chart demonstrates the 2026 mutual fund regulations overhaul. SEBI mandated a shift from the older total expense ratio model to an unbundled base expense ratio, capping index funds at 0.90%. Mapping this, mandating fee transparency is a protective function, executed via quasi-legislative power. This continuous drive towards faster settlement and simplified compliance, managed under current SEBI leadership, pushes the Indian market towards global competitiveness. The framework holds strong. SEBI is India's premier capital markets regulator, established originally under the SEBI Act of 1992. It is driven by a three-part mandate of investor protection, market regulation, and market development, and it enforces those goals armed with quasi-legislative, quasi-judicial, and quasi-executive powers.